Happens too often, but it does happen. It just is, data came, I think it happened a couple of meetings ago, a few meetings ago. So when that happens, when there's an important data print during the meeting, first day or second day, what we do is we make sure people remember that they have the ability to update. We tell them how to do that.
Embarrass yourselves on YouTube.
Some people do, some people don't. Most people don't.
You're on YouTube.
But, and I'm not going to get into the specifics, but you have the ability to do that. So that, what's in the SEP actually does reflect the data that we got today, to the extent you can, reflect it in one day. I think we'll, you will see PPI tomorrow. We'll know more about the PCE reading as the month goes on, but the initial CPI reading and its kind of first level translation to PCE, we did have this morning. We were briefed about it, and people were able to consider whether they should. As I said, some people generally do, but most people generally don't.
They got Trope system, Trope system. Don't shoot me, you bastard.
Hi, TATICAL, Janelle Martin from Bloomberg. As you noted, the labor market is now in many ways back to where it was before the pandemic. I wondered if you could comment on how officials are viewing that. So do you think that there still needs to be more cooling in the labor market to bring inflation all the way down to 2%? Or is there any sense that maybe the labor market is more vulnerable now to higher rates now that many of those imbalances have eased?
Come out with your hands up. Show me your hands. Hands, give me hands.
By so many measures, the labor market was kind of overheated 2 years ago, and we've seen it gradually move back into much better balance between supply and demand. So what have we seen? We've seen labor force supply come up quite a bit through immigration and through recovering participation. That's ongoing, mostly now through the immigration channel, but still we've had some increases in prime age labor force. In terms of on the demand side, we've seen quits moving down. We've seen job openings moving down. We've seen wage increases moving from very, very high levels a couple of years ago back down to more sustainable levels. We have seen unemployment creep up now 0.6 over the course of a year or so, very, very gradually. So you put all that together, what you have is still low unemployment, still 4% unemployment, historically low. But it's moved up a little bit. It's softened a bit, and that's an important statistic. But more than that, you've got strong job creation. You have payroll jobs still coming in strong, even though there's an argument that they may be a bit overstated, but still, they're strong. So that's what we see. We watch the labor market, of course, and the economy as a whole, but the labor market very carefully, and that's what we see. We see gradual cooling, gradual moving toward better balance. We're monitoring it carefully for signs of something more than
hands.
As a quick follow-up,
weapons free, vertical
make up the jobs report are showing different tales. There's been some divergence, especially we saw in the last report that we got on Friday. So how do you interpret that, and how does it change your view on the labor market?
So sometimes you can't reconcile the differences. You just have to look at it and try to understand, and that's why it always makes sense to look at a series, in 3, 6, and 12 months of things rather than just one report. But you're right to point to the last report where there was
down. I got one down.
Job gains, big job gains, establishment survey. So we're left with ambiguous results, and we have to deal with that uncertainty around data. Nonetheless, the overall picture is one of a strong and gradually cooling, gradually rebalancing labor market. Job openings, while they've come way down, are still, greater than the number of unemployed people. The jobs workers gap is still a significantly positive number, greater than it was before the pandemic. So overall, we're looking at what was still a very strong labor market, but not the superheated labor market 2 years ago, or even 1 year ago.
Ooh, that hurt.
Thanks, Chair Powell. Neil Irwin with Axios. Back on the rates path, the S&P showed quite a large shift of rate cut expectations relative to March. That's a period in which the economic data flow hasn't been that dramatic a shift. Can you provide some color on what changed in attitudes on the committee over the last 3 months to see a much shallower path of rate cuts this year?
Yeah, the big thing that changed was the inflation forecast. So the inflation forecast moved up several tenths for the end of the year, and as I mentioned earlier,
hold up, Smith, pull back, Smith.
what did we take away from this? We had really good inflation data in the second half of last year, then kind of a pause in progress in the first quarter. And what we took away from that was that it's probably going to take longer to get the confidence that we need to begin to loosen policy. So the sense of that is that rate cuts that might take place might have taken place this year, take place next year. You know, there are fewer rate cuts in the median this year, but there's one more next year. So you really, if you look at year-end 2025 and 26, you're almost exactly where you would have been, just it's moved later because of that progress. Now you get different data today. So we'll have to see where the data light the way. You know, the economy has, you know, repeatedly surprised forecasters in both directions, and today was certainly a better inflation report than almost anybody expected. And we'll just have to see what data flow brings and how that affects the outlook and the balance of risks.
First time I played with autistic, yeah.
Gina.
What I'm saying. Motherfuckers beyond autistic, half retarded.
Gina Smiley, New York Times. Thanks for taking our questions. In the summary of economic projections, the long-term interest rate forecast moved up a bit. I wonder if we should read that as a sign that you think that policy is not sort of as restrictive as we previously expected. You know, how should we interpret what that means about how the committee is the current policy setting?
So two things about that. One is this. You're right, it did move up, but I want to remember to point out that long-run neutral rate increase is a long-run concept. It really is a theoretical concept. It can't be directly observed, and what it is the interest rate that would hold the economy at equilibrium, maximum employment, and price stability, potentially years in the future where there are no shocks. So it's a little bit, it's not something we observe today. Today we've got a very specific economy with all kinds of shocks we're still getting over from the pandemic. So it's, I don't think that the concept of R-star, it's a very important concept in economics and in what we do, but honestly it doesn't really get you where you need to be to think about what appropriate policy is in the near term. But back to your original question, people have been gradually writing it up because I just think people are coming to the view that rates are less likely to go down to their pre-pandemic levels, which were, you know, very low by recent history measures. Now, we can't really know that. That's an interesting dispute and discussion to have now, but ultimately, we think that things like the neutral rate are driven by longer-run, slow-moving forces, and, you know, there's a really good question about whether those really have changed or whether instead rates and the economy are experiencing a series of persistent but ultimately temporary shocks. That's been the debate, and we can't know. But in the meantime, we're making policy with the economy that we have, with the distortions that we have. And I also, to your other point, I think it is the case that as time has gone by, the question of how restrictive is policy has become one that everyone's asking, and we're asking it too. And, you know, my answer has been that policy is restrictive. The question of whether it's sufficiently restrictive is going to be one we know over time. But I think for the reasons I talked about at the last press conference and other places, I think the evidence is pretty clear that policy is restrictive and is having, you know, the effects that we would hope for.
Tiger lilies.
Well, thanks to your pal Howard Schneider with Reuters. Just to carry that a little further, should we read this as a conclusion, the combination of tipping to one cut this year and acknowledging further progress on inflation as kind of a mark to market on the level of restrictiveness that you need, that you in fact have concluded that you weren't quite there yet?
I'd be reluctant to try to draw that conclusion. I think this is about you know, looking at the incoming data and asking how much progress are we making on inflation and how is the rest of the economy doing? Is the labor market still strong? That's what we're thinking about. You know, you can translate it into the language you're talking about, but to me the focus is more on we have a goal which is price stability, another goal which is maximum employment. How are we doing there? We think we've got a good, strong labor market still. We think we've been making progress toward the price stability goal. And then for a while there was a pause, and we look at today's thing and we think, well, that's a good reading, and we hope we get more like that. And in the meantime, we're asking, is our policy stance about right? And we think, yes, it's about right. We're prepared to adjust it as appropriate, but we think we're getting the things that we would want to get, broadly speaking. And that's why we've been at this policy right now for almost a year.
So just to follow up on that, I think
we're in.
All right, welcome back. Let's bring in George Silas, senior markets correspondent here on the network. George, your question for Powell was the first one asked right off the bat about core PCE at 2.8% year-end. Did you get the answer you were looking for?
Well, not necessarily. I thought that maybe there was a little bit more discretion in terms of the adjustment higher from 2.6 to 2.8% for the end of the year versus more quantitative in nature. They did talk about, and I do agree with what they said, in terms of the adjustment based on seasonality, because last year, near the end of the year, we started to see a tick up back higher in inflation, which started to subside at the beginning of this year. So to me, essentially, it looks like there was a little bit more discretion in their inflation outlook, and they're just being a little bit more conservative. So I took that as a little bit more hawkish in nature than not. The market started to drift a little bit to the downside since then. But nonetheless, I do think, what's really happening here is whether the questions are is whether or not we're sufficiently restrictive right now. And if you just even look at the back end of the questions, which were associated with the R star, which is the neutral rate. The neutral rate also, by the way, was 2.6. Now it's 2.8% with long-term inflation at 2%. So that's 80 basis points federal funds rate above inflation. Right now, if you just look at core PCE at 2.8, this is the higher adjustment alongside with one rate cut, that would still be about 230 basis points federal funds rate above inflation. So one would say that maybe the sweet spot was 2 rate cuts inferred by the end of this year. So it looks like to me that they're still being restrictive nonetheless. But they did denote that they're ready to respond in either capacity. One, if inflation starts to tick higher, they may stay where they're at. Or two, if unemployment starts to tick higher, they may end up easing a little bit faster than expected.
You can't have a
but George, I guess my question is why cut it all if core PCE is still expected to be 2.8% at the end of the year? That's why we back doing what
we do, man. I feel good about this one, baby.
I'm excited. And the thing is they're not going to wait till it's at target, because you have to consider that if the prices of production keep falling, but the cost of investment capital to make those goods and services continues to increase, that'll actually cause capital investment spending to fall, and that may dip us into recession. So what they need to do is make an adjustment over time. That's the ideal sort of Goldilocks condition, is slowly make the adjustment. So, I surmise, and this is just my qualitative view of things, that 2 rate cuts is something that would help alleviate some of the cost of capital concerns, because you think about higher interest rates are being passed through into the prices of production, the cost of capital, financial capital, and that may actually keep inflation high. So in other words, with higher interest rates, we may be at an inflection where inflation will remain high because of the cost of capital. So maybe if they start to move lower, that would appease everyone. Those who are really constrained because of high interest rates, but at the same time, it may also pacify investors who are looking for maybe rebounds in other areas of the stock market outside of these mega caps, which have created sort of an imbalance in terms of the breadth, which again is quite bad, considering about half of the stocks in the S&P are still trading below their 50-day moving average.
You buy low.
Right. Well, let's check in on the markets really quickly. Dow did turn negative, but just barely below the unchanged line. Nasdaq holding on to about a 1.4% gain. S&P up 1%. Russell up 2.2%. So off the highs, but still really holding on to these gains. Your thoughts on market reaction?
No, you got 10 short shares.
No, I think it's the right reaction. The point is they're actually keeping a bid on the mega caps. Apple and Nvidia aren't sensitive to rates, and so we're seeing a bid in those. We're also seeing a little bit of capital reallocation back into those from the interest rate sensitive areas of the market, just considering some of the housing stocks, even again the regional banks, and of course the small cap names, very sensitive to the rates. They started selling off during the announcement, and they've actually drifted continually lower.
All right, we got units, all types of units, be advised.
All right, yeah, taking a look, Apple actually adding up 6% now, Tesla up 5%, Nvidia up almost 4%. So good point there. George Silas, senior markets correspondent here on the network. Thanks so much.
I just thought about 44. I said, damn.
And thank you for joining me on the watch list. Our special Fed coverage continues with Market on Close with Oliver Rennick next.
Good afternoon. Welcome to Market on Close. I'm Oliver Rennick. Thanks for tuning in. Thanks for being here on the Schwab Network for a fun Wednesday. A big one. Inflation this morning coming in light, but Jerome Powell distinctly not taking the bait to really celebrate or take a victory lap. He certainly could have.
Show me your
Today's
hands. Show me
message,
your
what we're hearing
hands.
from the Fed chair is not about what he's saying, but what he's not saying. Which is generally, he's towing the line, saying a lot of what he's already said, not changing that tone, despite a really good number this morning. He did say, this is a great number, we'd like to see it, we were surprised at how good it was, but he also said voting members did have the opportunity, if they wanted to change their outlook based on today's number. Guess what? Nobody did. Maybe it's just the idea that they don't want to take one print and extrapolate too far. Maybe it's that they feel if not a big enough shift in the trend in the direction of their inflation target. So however you want to interpret it, if you were looking for Powell to give you a very dovish response and a hyper-excited analysis of the recent data, we're just not getting it. So that probably should and very well could limit further upside for the day, just because the market has been celebrating the print all day and did clearly from the moment it came out. So you see the dollar come back a little bit, recover some of its lost ground, and bonds to give some of their gains back and yields to creep higher. Makes sense that those two things are pushing against their early morning response. Now it still is pretty clear across the board what's happening here, which is a tech-supported and now macro-added bull case. We've already had the tech bull case. Everybody knows that. He has been going nuts.
Don't you run. Don't you run, big ass nigga.
What we didn't really have was a super bullish macro case. Macro's been chopping back and forth.
I got flankers
We were just thinking about reflation risks a month and a half ago. Then we were worried about slowdown risk. Now that we got a good jobs print combined with a good inflation print this week, markets went ballistic this morning, hoping that maybe Powell would match the enthusiasm. Rally, at least the part that's macro-driven, now seems a little bit out of place because Powell's just not celebrating because he shouldn't be. He still has work to do, as we still have numbers above their target. There's a lot of implications that the market, journalists and others have tried to push Powell to maybe revise his target or act before we get there. And it's clear he's not going to, and that the Fed members don't want to, because we narrowed down our cut path for this year substantially shallower now to just one cut instead of three. Bonds are rallying anyway. TLT's up 1.3%. Now, if you look on the year, bonds and the dollar, though, are telling us something slightly different. The yields are cutting below last month's lows. That's the blue line, the 2-year. That's important because when we define trend, lower lows or higher highs are what define it. And so the 2-year yield, the one that's linked most closely to the Fed's short-term decision-making process, is making a lower low. That's telling us that, yes, we're still on the direction to cuts, not the hikes. That, keep in mind, literally in April, when yields were pushing back towards 5%, we were worried that maybe hikes would come back into the conversation. We, as in the collective market analysis, you started hearing that creep back in. But the dollar's a little bit different. See, the dollar's not making the lower lows. While the 2-year makes the lower lows, telling us that, okay, take the hikes out of the conversation, stop trying to bring them back in. It's a matter of timing for cuts. Dollar still is actually quite range bound. The dollar is actually kind of stuck still in the last 3 to 4 weeks. The dollar to me is always a better read, really, on the difference between the market's expectations and the Fed's plan. So even though the dollar is down today, it's coming back a little bit and it's still in the range. I think basically Powell's response to this morning's print is telling us that if we come in tomorrow and PPI is hot, then we might just be undoing the move that we've made today. He wants to see more information. This is a good piece of progress, but he needs to see more progress. The message hasn't changed on that, and their actual economic projections are showing that they're a little bit less dovish than last time. So it is not equivalent to the degree of celebration the market has applied to it so far. We'll see if that limits the upside. Don't think it has to create a sell-off, but it does make sense to kind of limit the upside when today has been a very high beta rally. You also see it because Bitcoin and gold are both up at the same time. Two things that serve very different purposes. Bitcoin if you want to take extra risk, gold if you want to be extra safe. But the times when they rally together is when you get everything rallies. The market needs the macro perfection and a dovish Fed to have that type of everything rally, which we haven't been able to get. We've had a tech rally. Today it's trying to turn it into an everything rally. I do think the lack of celebration here from Powell, the very measured tone that he's giving in response to these numbers, suggests he's still willing to hold out and that he's going to need more information. It's not exactly what the market was hoping for this morning. And Kevin Hanks and Jenny Horn here with me. I kind of like the idea that it's what he's not saying versus what he is saying, Jenny, because we're not saying anything.
Nothing new. I said to you, I would have hosted this press conference because it was the most. We've been there. We've talked about this. Nothing new information. Boring press conference, and I like the press conferences. So my bar is pretty low. But
I hear my voice, come out with your hands up. This is Special Director Sims. You are now underneath hostile
questions pretty good. Some of them in there that I thought were pretty good. Talking about, you know, kind of what was the data between now and the last
give me grenades.
Give me grenades. That caused you guys to move a little bit more.
Grenades on the ready. Grenades.
They did, but we also continue to couch with the same thing he always says, Kevin, about the dot plot, which is it's not set in stone, it's not a plan.
There he is. He's on our position. Take cover.
Said
prepare to engage on my command.
Another 4 said none.
Basic maneuvers.
And 1 said no cut this year or next year.
Pull back.
So
leave him one. Pull back on my position.
Move down. Now you're right. He said, you ask any member of the
Fire
Fed
wheel. Pull back.
It means they're done. They said,
we got hyper aggression on our unit.
We're still data dependent.
Making
We're going to wait
contact
for
with
the
the enemy.
data. And the data's not there yet.
Come out with your hands up. Show me your hands.
How he talked about
pull back. I told you pull back.
PCE from 2.6 to 2.8.
Pull back.
He basically said there's very weak numbers coming off the board.
Show me your hands.
And if a 0.2 or a 0.3 go on, that number's going to drift higher. So get ready for that.
Data dependency.
Yeah.
Right? This is where the market seems to continue to kind of.
It's kind of. And so even with all this, even with everything they said, what about September? They asked them about September right away. They want September so bad.
I was hearing tweets about July today. I'm like,
looking at the range of plausible outcomes. He dodged the question completely, as he should. He shouldn't come, because guess what? If you commit to something, you wind up doing what the ECB did, which is lowering rates and raising your expectations.
You want it, come take it, brother.
You're painted into a corner.
And I'd say in the same breath, how could you be say you're data dependent and also make such long-term projections? Because there's so much data that has to come out between now and then.
Well, we asked them for long-term projections.
True.
They basically will come out and say, don't put a lot of weight in these. We do it because you ask for them, but they mean nothing.
Yeah.
Jerome Powell has all been saying.
Brother, you want it? Come take it.
The dots mean very little. It's the data constantly that moves us.
How do you think the impact on the market looks right now? I mean, we've dialed back the bond rally a bit. We've bought the dollar a little bit. The dollar, I think, is the most interesting one because, like I said in the open, it's holding its range here from the last month. The dollar's not breaking down in the same way, which still gives you, I think, a pretty clear message about how we differ from the rest of the world.
The dollar came off its lows.
They were scared, y'all. Pussy, they was hiding. They over there hiding. They
is a more hawkish response than maybe the market was thinking. I think that's why the dollar rallied. Remember, the currencies are what I call them very simply is a hawkish concept.
What the fuck you scared for?
And the fact that you mentioned he was less dovish, I consider it more hawkish. That would put a slight bit in the dollar.
I can hear your heart beating.
The rally has stopped, but that doesn't mean we're selling off dramatically.
No, and we're not. And I mean, really, the high of the morning came at 9:30. So we've chopped around. Happy to see how it goes in the next 50 minutes here because it seems very reasonable that we don't need to turn this around. And we still got a good data print. That's the bottom line. The other thing too is just we don't even really need any cuts for the market to work. We don't need something revelatory. We have Apple up 6%. And on top of yesterday's rally, I mean, just what's happening in Apple is pretty nuts here over the last 2 days, how apparently everything has changed. I mean, the way the market views it.
It's ridiculous. Apple is trading like a meme stock in the last 2 days. It's up almost 13% over the last 2 sessions. It added $215 billion in market cap alone yesterday and adding another, like 200 plus billion in market cap today, which then does regain its title as the most valuable company, surpassing Microsoft. I mean, NVIDIA was short-lived that NVIDIA took over Apple as a more valuable company. I think this speaks to, it's not that the bullish case has gotten more bullish, it's that some of these bears that were sort of digging into the AI narrative and being pessimistic about, there has been reason to be, I say, cautious on Apple this year, but it's to me more of the bearish camp that's saying,
Okay, so best case scenario is the AI is a huge opportunity. Worst case scenario is the upgrade cycle isn't maybe as strong as we think, but it's still Apple. I think that has been what the bulls have been arguing all years. This is still a company that seeks such high demand from its consumers. I think this is like right now what they laid out at WWDC is like a pretty much like a win-win scenario. And we've just been too down on that company.
Yeah.
You look at the first time that Apple crossed 180, it was years ago. This is a massive catch-up.
Yeah.
In like just 2 days.
Yeah. Well, they did. Yeah. High frequency trading will do that. It turns 2 weeks into 2 days.
The reason why, too, to me, it feels way more speculative than anything we saw in NVIDIA, the chips, is that was all backed up by earnings. The NVIDIA valuation now has been really lifting off. But there were months where that stock was rocketing, the valuation was steady because the numbers were so extraordinary. That's not the case for Apple. Nothing that was shocked. There was no earnings report. This is pure speculation on what they're going to deliver, how people are going to receive it, its product, its services. Totally different than an inventory build-out that only shows up on the bottom line for NVIDIA. So I think by definition, the Apple rally is way more speculative.
Well, the fact that you need a 15 or a 16 to get the AI, and only 5% of people have a 15. It kind of set off a little light bulb in everyone's head. Wait a minute, you may be going into a massive upgrade cycle. And so I think it's the bet on the future.
But I think that's the only reason of this rally, because frankly, like nothing was a surprise at this event. I mean, we pretty much knew about ChatGPT. We pretty much knew about some of these features that I was arguing, like why is this?
Why didn't they have it already?
Yeah, right. Where have you been? So I mean, like there was no fireworks at this event, but we've just seen. I think it's that less than like 10% of the overall iPhones right now are eligible. So is this going to drive people to spend hundreds of more dollars?
Yeah.
We'll find out.
All right, good stuff. Okay, right now, as long as Apple's doing what it's doing, though, we don't need any highly dovish Jerome Powell. We're doing just fine. Okay, thanks, Kevin Hanks, Jenny Horn, joining me to continue discussion the macro conversations. Campbell Harvey, professor of finance at Duke University, director of research at Research Affiliates. Campbell, so I know that you've been looking at the economy from a sort of more negative lens, thinking that some of these numbers are not quite what they appear. I'm curious what you thought about the way Jerome Powell kind of discussed the recent data and the possibility that maybe some of these jobs numbers aren't all they're cracked up to be.
Yeah, so let me first talk about the inflation data, and it is super frustrating. There is a gross misread of the data. So we talk about, oh, well, good news, the month over month was flat, 3.3% year over year, but that is due to one singular number, and that is the shelter component for inflation, and that's running at 5.4%. So shelter is more than a third of GDP. So think of it this way. Gasoline is 3.6% of CPI, and shelter is 36%, 10 times the share. It's running at 5.4% supposedly, but just casual inspection of data tells a different story. So for example, Zillow says that rents year over year are 3.3%. Well, if we use 3.3% instead of 5.4%, inflation is not 3.3%, it's 2.5%. Or if we go to a different source, like apartmentlist.com, they say rentals year over year are running at negative 0.8%. So you substitute that in instead of the 5.4, and you get an inflation print not of 3.3%, but of 1%. So you take the average, we are at the Fed's goal of 2%. I have no idea what's going on, how they can fundamentally misread the data. That 5.4% is so far removed from reality. It makes no sense whatsoever. And hence we're in this situation where the Fed is going to delay the reduction in the Fed funds rate. And again, that it's unfortunate. The Bank of Canada, the ECB has already begun the cutting cycle, and the Fed is holding tight based upon data that's stale. The 5.4% does not represent shelter inflation.
So Campbell, when we think about housing and the role in what we spend and our experience, in the economy, can we just exit out though I mean, isn't that a huge impact on how we feel and where our money goes?
So what I'm saying is that if you look at real-time data, it's nowhere close to what goes into our CPI. And the Fed should be making decisions based upon real-time data. They should not be making decisions upon stuff that's already happened in the past. So the accuracy of the CPI report, I'm questioning. And I'm also questioning whether the Fed should be using this 3.3% that is stubbornly high. You look at the releases and stuff like that. They are so focused on inflation, yet why not drill down to the components and figure out what's going on in real time? So I think that this is going to be very costly. And one exhibit that you flashed a few minutes ago was the Fed's expectations for GDP growth, and they're miserable. The long-term growth is 1.9%. We need better growth than that. What happened to our ambition? So what happened to like 3 or 4% GDP growth?
Well, we were there a couple quarters ago. We just came off pretty hard.
For a quarter. Got to look at year over year, right? Anything can happen in a quarter, and that's noisy. I'm talking about year over year. So we need to get back to robust growth, and having a Fed funds rate of about 5% in a situation where real-time inflation is in the Fed's comfort range, 2% or even less, makes no sense. So the Fed is gambling the future economic growth, and it is a misread of the data.
Well, Campbell, not to go like to have a snake eat its tail here with this question, but they're basing it, when you say that if they change CPI, if they change inflation to take out, to update the housing at a faster rate, then it would be below their target. But their target's based on the way it's calculated right now. So then wouldn't that cause them to change their target? And maybe that target would be something different. I mean, it's not like we changed inflation data in the last couple of years. This is the way it's been. Correct me if I'm wrong, is this the way inflation was calculated when you did your study on bonds and economics and everything? I mean, we haven't really changed the scale, right? So if we haven't changed the scale, then how do we know how they would respond to different numbers? Because I would think they'd have to change their standard for the numbers too.
Great question. So there's two parts to the answer. Number one, the Fed's goal is a long-term goal. And that's exactly what I'm talking about. So it's not like the goal is to achieve stability with the 2% inflation rate over the long term. The second thing is, well, what happens if you kind of change the way you put the data together? Well, they already did that. So they did that in 1982. So if we were using the methodology before 1982, inflation would be probably between 1.5% and 2.1% year over year.
Okay. So the other thing too I'm wondering here, Campbell, is because we're talking a lot about the trade-off between other economies here, and if it seems like they're setting us up for failure by not having this fresher, faster inflation reading, because that's the argument, right? That they're going to take too long to act. By the time it looks like the stuff gets to where they want, it's already going to be having kind of broke this sort of levee. But we're the ones that are still doing best above growth trend post-COVID, right? I mean, it's still working reasonably compared to other economies. How does that factor into the way you think about the sort of malfeasance that you're almost implying here that the Fed might be slipping into?
Yeah, so again, it's an excellent point. So let me tackle it. So number one, it is true that the Fed is operating with an inexplicable lag. So what I'm talking about, this misread of the inflation data, this is nothing new. Do you remember when inflation was surging and the Fed was saying, oh, but this is transitory. It's no big deal. We don't need to do anything. And they waited and waited and waited. They ignored the real-time data. And in this case, Shelter was screaming double-digit inflation. Yet what was going into the CPI was like 2%. So observing real-time inflation at 10% for Shelter, and then what goes into CPI, 2%, it's the same problem. So the Fed was late to the game. They had to increase interest rates very severely, and they're keeping them very high and making the same mistake again. Now, the second part of your question is, well, the U.S. is doing okay compared to other countries. Well, that's true. And in the counterfactual, where there was a different policy, the U.S. would probably be doing better anyways.
Okay.
But the point I'm making is, yes, we are doing better than other countries, but a 1.9% real GDP growth rate, I'm not impressed by it. And I don't care if the EU is 1% and we're 1.9%, and we're doing better, like we're doubling the EU in terms of real GDP growth. That's not good enough.
Yeah, don't judge yourself by others, right?
Exactly.
All right. Campbell, always fun chat. Appreciate you being here. Like your interpretation of the situation. We'll definitely keep our eyes peeled. Your yield curve unchanged. So, it's a good combo because our bond talk is doing nothing. 10s to 2s are stuck in the same place they've been for months. Appreciate you, Campbell. Thank you very much for your time.
Thank you.
Mr. Harvey, Professor of Finance at Duke University. All right, coming up, let's talk some options. Let's do a little bit of trading here. As we think ahead to other events on the calendar, how will data dependency factor in with election season as well for the Fed? Coming up next.
No, you're not solo. You don't want to solo.
Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Knock, knock. #1 broker here for the #1 hitmaker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Come out with your hands up.
Take his Carl.
Grenade.
Schwab.
Have a choice in how you invest with Schwab.
Be part of the latest commodities action on Futures with Ben Lichtenstein, weekdays, 8 a.m. Eastern on the Schwab Network. Available anytime, anywhere, on any device for free.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to Market on Close. Bringing in Danny Kirsch, joining us for Piper Sandler, head of options. Danny, great to have you here this afternoon. Market seemingly okay as Powell kind of dodges anything dramatic. So is the dovish potential just a cherry on top? All we need is NVIDIA and Apple? I mean, maybe we don't need the Fed.
Yeah, I mean, today's pretty interesting. So I put something out a little earlier. Dow Jones flat, Q's up almost 2%, and a lot of that's driven by Apple and NVIDIA. I heard the conversation earlier. One other thing to keep in mind is that there was a trade people were playing for Friday, that if the market cap of NVIDIA got to be greater than Apple, the XLK would rebalance. So it rebalance the weights of NVIDIA and Apple, so there'd be a ton of Apple to sell on Friday and a ton of NVIDIA to buy. And I think there was some pre-positioning for that potentially happening, because as of 2 days ago, NVIDIA's market cap was greater than Apple, and that's flipped the last 2 days. And you saw part of this unwind seem to happen after the developers conference, where, if you remember, the stock didn't move on the developers conference. It actually sold off, and then it just took off the next 2 days. And today and yesterday, there's been north of 5 million call options have traded, which is the most in several years in Apple. So to your point on it trading like a meme stock, it kind of is the case. I think 15% of option volume today was Apple, and I think the other 15% is NVIDIA. So these two stocks are really just driving this massive outperformance. And yeah, absolutely, the inflation print today helps. IWM is rallying. Powell, I think, you know, it almost seems like what he was saying was more dovish than what the dots and everything showed. And I think he tried to make it very clear. It's like, we're still planning the cuts. It's just pushing them back slightly. And at the same time, if the data rolls over, they can just cut faster. Like that's certainly, this is all like sort of a weird, like this whole press conference he does, where he does a press conference now after every single meeting, seems completely unnecessary, because the inflation data softens and the NFP data continues to soften, they'll be cutting. So none of this almost matters.
Yeah. Okay, so I like the macro take, but come back to Apple for a second there, because I just want to clarify. You're basically saying that people were trying to front run NVIDIA leapfrogging Apple, that was going to create a rebalance momentum chase in favor of NVIDIA, but then when Apple bounced so hard after WWC, people go, oh, we got to own Apple. Is that right?
Right, it was like, right, so this will just leave things as they are, but I think there was this trade where as part of this XLK rebalance, so 22% of the XLK right now is Apple, I think 5 or 6% is NVIDIA. That would just swap, that would flip if NVIDIA's market cap was greater than Apple on Friday. And so there was this play where I think people were chasing NVIDIA higher and pushing, you know, betting an Apple a little lower, and that perhaps is being unwound more so on the Apple side. And I think generally a lot of investors are underweight Apple because it's just steadier, it has less of that growth profile as a name like a Microsoft or NVIDIA. So oftentimes it's almost like a closeted short, because you don't really, it doesn't usually rip 11% over the course of 2 days, and you're seeing that just like an explosion in call volume. Like this is it's very strange, because the event happened 2 days ago. So like, as far as a catalyst, you know, do you think people will be lining up outside like they used to buy a new iPhone because of the updates they mentioned? Like logically, is that what's going to happen?
Absolutely not. But you're asking guys who never lined up for Apple anything ever. So barking.
I just think it does.
Our go-to, and she said she wouldn't. So I trust what she says.
Okay, well there you go. I just think it's like there's this. This is also, I think, a function of what's happening in this low volatility market we're in. Even with this explosion in call volume, Apple's short-dated calls are 20 implied vol, 18 implied. Just like options are very cheap, and I think this is a great example of why people are sort of switching out of their stock exposure in favor of call options, because one, you can have these explosive moves, and two, implied volatility is just extremely low. Like options remain underpriced, particularly on the single stock side, but I'd say arguably on the index side too. In a grinding higher market like we're seeing today, where market's up another 1%, can obviously make a ton of money being long S&P calls.
Yeah, well, you've got a chart that a couple that just show how cheap. I mean, it's really, really cheap to own
shoot her down.
vol
We got
right
shooters
now, because apparently you don't need to. You haven't, because it's just you know, ramping. But
I see him now.
you know, we also still haven't seen that kind of frothy melt up to a certain extent. So I mean, is any of this, like, even if you wanted to stay, so the puts look really cheap, right? Okay, I get that.
Yeah, everything looks cheap. So everything looks cheap. This is just looking at like 6 months, 1 year. Everything is very low price relative to how much we're moving. This would be like, so if you wanted a longer term hedge, we're saying go out a year, buy a 5% on the money put, and then just don't do anything. If we get some sort of crash or some sort of shock move, these will pay off, even if we rally a lot, because the implied volatility is so low everywhere. And 1 year out, you get the election, you get potential surprises. But shorter term, we're suggesting to clients, hey, if you're long the market via futures, via stock, it's a great environment to replace your long stock exposure with calls. Because, as you saw on a day like today, like even Apple implied vol was, I think, as low as 15 or 16. It's jumped to 22. I still don't think very high for a stock that moved 10% in 2 days. But you're winning on both ways, where you're winning on the implied volatility and you're winning on the delta. So that's like, to me, like, this is just good risk management in a low vol world. Sell some of your stock exposures, buy some calls to replace it.
Yeah, all right. It seems like it makes sense, especially because there's more than there's like, what, 2 out of 3 scenarios where you'll be happy there, right? And to me, that's always kind of like the holy grail of trading. Can you get one to have a 66% chance, basically? And because there's a scenario where, you know, the vol could go up even if the market goes up.
Marine down.
And we're also entering this like awesome seasonal time where we have a holiday next week, and then July is just a great seasonal to be long.
We got 2 Marines down.
Do you want to guess the last time Qs were down in July? What year that was?
Down in July, so 2018 maybe?
2008.
2008? Jeez.
So
we better hope we're not down in July.
Yeah, I mean, it just doesn't
June's like one of the worst months, so we got to get through this month.
Yeah, it's been terrible so far.
Right.
Scorpion 1 to Scorpion 9,
June's like
take
third worst
cover, all
month. They're the
units.
worst by some standards. So Danny, hey, real quick, one last point on the macro, along with the vol conversation. I think they intersect. Powell says we're data dependent. You know, you look at the SEP, make of it what you want. We're not committed. But then we've got this giant election that in other years maybe, you know, we would just say, look, whatever happens, markets go up. But I mean, last time it was crazy. So like, how does that factor into any of this? Should we be just putting our expiries like right before the election?
Well, I love trades. Well, we've been doing a lot of is selling options that expire before the election, depending on your view, and buying options that expire after. For instance, this is just the implied move, the S&P for the specific for November 5th for the election date. So the S&P right now is implying a 2.5% move. I'd expect that to increase as we get closer. So oftentimes what we'll see clients doing is you sell options that expire in like October to buy options that expire in November. And one other trade that we really like here is the flip of something you and I have talked about in the past. In the event that Trump wins,
man, they bounded on us. They bounded on us. Multiple shooters, multiple shooters. Multiple shooters, multiple shooters.
25% the next month.
Multiple shooters.
So trade you can do
They on the hill. They on the hill. Take the hill. You bitch ass niggas running this shit. You fucking
as of
faggots.
today. That will change as time passes. So one trade that we've been doing a little bit of is you sell September, October KRE calls to buy December or January KRE calls. And we think this probably works well. I mean, it certainly worked well if Trump wins. Probably does fine if Biden wins, just because you expect implied volatility of options that catch the election. We would expect to increase as the election approaches. So this is just being like smart with the fact VIX is super low, long dated vol is super low, correlation super low, options are cheap, even options that catch the election are cheap. Take advantage of that now while everyone's kind of asleep at the wheel, and set up your election trades where, you know, maybe if we have a quiet summer, great, you collect some theta in the meantime, and then August, September, October, then everything starts heating up, and all of a sudden any option that catches the election, we would expect the implied volatility to start expanding.
All right, great stuff. Bunch in there. Great conversation. Lots for us to process. Thank you very much, Danny. And some VIX calls might have actually worked in the last like 5 minutes because we're fading a little bit.
Oh yeah, we went up, but we are fading a little bit.
Tiny bit. Thank you, Danny Kirsch. Great conversation.
Thanks.
Have a good one, sir. Thanks for being here. Head of options at Piper Sandler. Love that. All right, a lot of good stuff in there. Let's keep it going. We're going to take a look at the levels to watch heading into the bell. Kevin Green checking in on the gamma stuff. Flows next.
No politics, no noise. From bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
My dad was a hard worker. He used to do side jobs installing windows, charging something like $100 a window when other guys were charging $400 or $500. He just didn't want to do that. He was proud of the price he was charging. My dad instilled in me, always put the people before the money. Be proud of offering a good product at a fair price. I think he'd be extremely proud of me. Yeah.
Binge watch the market with Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all of your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free. Schwab Network.
All right, stocks coming off a little bit here, having some trouble. Let's bring in Mr. Kevin Green, figure out where the levels are and the big traders waiting to push us around. KG 5450 texted me earlier, said that was the next wall we had to get through. We didn't.
We did not. We came in, what, 2.75 points away from that, and then we did fade as soon as the meeting was actually done. And I was actually IMing one of the producers, and I was like, man, I wish we were on like 10 minutes earlier because we could actually see this in real time. But Oliver, what we actually did see today was a very light volume in the SPX options, and that's not surprising when we have an FOMC meeting day. But it is a little bit surprising we have a CPI day. We were looking kind of like for a little bit of a blend for today. And obviously, it's one of the lighter days that I've seen in a very long time. But going into the close, here's some other strikes that actually were very interesting as we were at those levels really close to that 5450 level. Saw a lot of individuals actually selling the 5420 puts, trying to receive premium, and then we saw a lot of buyers getting into the 5400 puts, which was actually very interesting. Now, we may not get to that level here today, but somebody did, let's say, clip a lotto ticket, if you will, to try to see if there was going to be a downside move, and rightfully so, we did see one. 5420 is going to be a very key area to hold. When you're looking at those that are actually selling premium, though, that means that the dealers themselves are actually long the 5420, so they're not really too concerned about this move. They don't have to tighten up this market. They're going to let it kind of play out in itself here. The other side of the coin, when you're looking at the long side, 5460 was an area that we did see a fair amount of flows in, and just like I said earlier, today was just a very light volume day, so this is actually being driven by equity performance rather than these gamma levels, if you will. Now, maybe that changes in the last 30 minutes of today's trading session, but very interesting flows going in, and then kind of seeing that reaction after the meeting was done.
Got your ass. He saved you.
Kind of see
He saved you, boy. I was on you, Scorpion. The Scorpion was about to strike. The Scorpion was about to strike.
So where is the kind of that maybe floor for support? It seems like the areas in which there's a little pushback to the upside have kind of been established here. If we start to, I mean, look, we have 20 minutes left. Anything's possible, you know, on a Fed day. It doesn't seem like we have a reason, you know, to crash because a bunch of these big tech stocks are doing fine. But like, if we get down there, where should there be some support?
Actually, at the 5420 level, they did break through it a little bit here, but usually when we have individuals buying these puts before the move to the downside, what are they going to do when they typically get to that strike level, right? They tend to sell out of those positions. So if you had buyers of puts or if you had sellers of puts, they're going to try to reverse those positions. We are actually reclaiming the 5420 level right now. So there might be a lot of action going into this close, Oliver. And just kind of keep in mind, the line in the sand, if you will, if you're looking at the open interest in what we actually saw today, we kind of highlighted some levels yesterday. That 54 level was actually the area of resistance. That was the positive gamma level for dealers. But we opened up this morning higher, and what happens with resistance? It becomes support.
Yeah, you can UAV all you want, brother. But the Scorpion still will strike.
Interest is actually going to shake out after today's close. We'll have that updated by tomorrow, and then that's going to be able to give us a nice little range. And then for this particular chart, we are just showing that pressure level, or this equilibrium level, if you will, is 5430. 5430 is the equilibrium level. So if we have that positive gamma level, which is 5450, that resistance area, the lower area is 5400 right now. 5430 is kind of that even keel area that we could range around. I don't think that there's enough volume here today, though, to really kind of create a melt up scenario in this environment. And if we were, I actually have it highlighted in that yellow there. If we were, we would have to break above that 5465 level in order for us to really unlock that gamma squeeze, and that gamma squeeze can bring us up to 5480. So another 20 points if we were able to bring that break that level. 15 points, 20 points.
Few quick things. I love when the fundamentals and other things line up with what you watch from the flows perspective, because fundamentally with so much on the calendar today, I was writing a newsletter, the potential for melt up. Like, this was the day, right? And then to see that we got through the key levels to then kind of spur some of that forced buying, we did really melt up. But then there's another catch that's kind of a fundamental thing, is that the reason June is typically a bad month is because there's low volume. People are gone. So since stocks usually go up over time, a dearth of buyers, because you just need that displacement, more buyers and sellers, lower volume months do generally more poorly. And it seems like part of the limitation for really taking off here today, apart from maybe the power is not perfect, is that there's just not enough volume to really kind of force the hand of some of these market makers.
And that could also go the other way when you're talking about price as well, right? If you actually have low volume markets, you can actually push price to the upside or downside very aggressively. But I think what you're kind of highlighting there, Oliver, is that it's not sticky flows, right? It's not something that's going to really create these walls or resistance or support levels. It's just something that can create some pretty decent price action. But when you're kind of in those environments, you definitely want to have your risk parameters in place in order to make sure that you can cover yourself if we do see a reversal in trend like we actually saw here earlier today. Now, we actually do have this histogram chart up, and this is actually a pretty decent chart. This is showing just the volume flows itself. You can kind of see that 5,400 level was a key area. 5,450 is also another key area to kind of keep in mind here. But the market's still bullish. So if you're looking for an immediate reversal because the market's so lopsided to the upside, we're just not there yet. You need to have a fundamental catalyst in order to turn us lower, and you're just not seeing it when it comes to the options flow. Not a lot of hedging activity taking place to the downside, which could create gaps in a sense, but if no one thinks that there's going to be a bearish move, then is the market really going to turn bearish? That's the biggest question outside of an event or a black swan event that really is unforeseen.
All right, good stuff. Nice look, KG, and good levels this week. We really took off this morning as we got through some of those thresholds.
The bogeys that got us might not be too far behind.
Coming up, we're going to talk about a little bit of a bounce back in the dollar.
I'm coming for you, you motherfucker.
You
thought you wasn't going to pick me up. You said go back to the lobby, didn't you, motherfucker?
Bitcoin backed off. Dow went back red. We'll also tell you about the latest in the weight loss drug business coming up next.
This shit bag. He's really annoying on the mic. Come on, let's go.
I'm back.
Yo, he's right there behind the wall. He's right behind the wall. He's
Get
right
that
here.
motherfucker.
Your teammate's right here on my body. On my body.
On the body, on my body. Get him. Fire wheel.
Number two. Come on.
Engage the enemy. Engage the enemy. This is Falcon 1. Falcon 1. I need Falcon 3 engaged.
You're gonna go back to the lobby, but you're not gonna come get me.
Falcon 3. Falcon 3. We can't resist. We can't risk the whole damn map for you, brother. The shots fired. Shots fired. This is Falcon 3. Falcon 3. Prepare to engage. All tactical units respond. Respond. Prepare to engage. This is Viper North. Viper North. Oh, sniper fire. I'm hit. Hit. I'm hit. He's on top of the building.
Spotlight the biggest market trends on Trading 360.
He's on top of the building. Get out of there. Get out of there. Take evasive maneuvers. He's on the building. Get out of there. Evasive maneuvers.
Ethan!
Man, you waited until you finally killed us. You was a pussy faggot. You heard me screaming at you the whole time and you ain't said nothing. Don't wait until you talk now that you got the upper hand.
All that research sounds
exhausting.
Nope. Schwab's technology does the work. So if I spot an opportunity in robotics,
because you were scared of shit when I was coming for your ass.
in a few clicks.
Can't be that easy.
It is with Schwab.
Schwab investing themes.
Watch out, watch out. Sniper fire, sniper fire. Take cover.
25 stocks in just a few
Take cover,
clicks.
take cover. Zink, zink.
Binge watch the market
Evasive
with
maneuver.
the Schwab Network. Tune in 24 hours a day, 7 days a week at SchwabNetwork.com and on all your favorite streaming services.
I tell you take cover, goddammit. You fucking
Available
Oh my
anytime,
God.
anywhere,
This guy's
on your
trash.
device for free.
You got lucky
Schwab
today, motherfucker. I was coming for you.
All right, we lost a little of our mojo there. Equities are still doing just fine, but the Dow is red. Bitcoin pulled back a little bit, back below 68.5. Joining me, Dan Deming, here with us today, managing partner, KKM Financial. Dan, so look, we're trying to hold on to most of our rally here, but we're having a little trouble post-Powell. What are you watching?
Yeah, we are, Oliver. You know, kind of the effect is wearing off a little bit. I kind of was surprised that we held up as long as we did, based on the fact that he pretty much negated any kind of idea that they're going to be considering cutting anytime soon. But at the same time, reiterating that the economy continues to remain fairly strong. So there's no need to consider that at the moment. And they're really focused on inflation. So I think that that's part of the reason is that kind of now we got through the press conference and there's kind of this all right, second look now as the markets digest, you know, the message and the end result and overall the data. But then we have more data tomorrow, so that could influence the market. So I think you're just seeing some end of the day selling, but still holding up, Oliver. Yeah, there's the dispersion continues. I mean, consumer staples, healthcare under pressure all day long, but the tech sector, you know, for the most part, holding up pretty well today.
Yeah. Tech holding up, that's our bedrock, definitely. Seems like it's going to take something real profound to break the dollar, though, as, you know, that really keeps finding a way to come back after it drops.
A little bit, yeah, at this 104.3 level. I think at, I'm looking at 103.8, Oliver. If we were to go down another half a point from here, that would be a lower low in this pattern that's been developing, and that could potentially break the dollar to new lows and break it out of this area where we have been able to hold this 104 level here, or at least for a little while, and then push back up towards the 105. Pretty much range bound, and really when you look at the price action, the euro is getting back to the recent lows after making new lows. It's kind of bouncing back at least to the recent lows. But what is interesting is there's dispersion there, and you're seeing relative strength in several of those pairs trades, particularly when you look at the British pound relative to the euro. The British pound is nearing basically almost 2.5 month highs here, even with the euro.
All right, boys, stay tight.
Yes, sir.
Wasn't I just in the game with you?
No, that was me.
Does he have a golden gun? Golden gun here. Oh no, it wasn't you. The hill sink guy. Contact, we got shooters in the building. I got shooters in the building. Evasive maneuvers. He right there on you. Shooter. Keep moving, stay alive, soldier. Remember your training. Get out of there, break contact, evasive maneuvers. Nah, we tried it, he tried it. He tried it, boo.
What's up, boo-boo?
He tried it, boo.
Where your boy going, boo-boo?
You guys have any keys on you?
No, brother.
You guys want to go to the zoo? Guys.
Let's go, brother. Anywhere you want to go, brother. You need to become ultimate.
What is the process?
Scorpion 1, get me out of here.
You fucking coward. You coward. Shit. Yeah, no, he left. What are we doing? We leaving?
Nah, you don't know what to do. What was y'all doing before? Multiple shooters, multiple shooters.
Let's go and got the key to the stronghold.
Multiple shooters, stay frosty. Contact. Hit him hard and hit him fast. Reload. Hit. Multiple shooters, multiple shooters. Remember your training. He got that Glock 9 with the switch on it. You got a switch. That bitch got a switch on it. And they got the switch on that bitch. Shots fired. Good work. Stay together. Remember your training. Oh, this nigga got the keys to everything. He got the Illuminati. You think you the Illuminati? Fire at will. Uh-oh, we got Marine down, Marine down. Marine down.
Buddy, shut up, buddy. Watch out, there's someone coming.
Pull back, pull back. Reloading and engage. Take cover. Bullets heal you. There you go. Reload and engage. Fire wheel. Engage the enemy. Shot fired. Sniper fire. Right there, multiple Charlies.
Yellow. Next film.
Y'all better move.
Take your heart.
On the double, on the double. Keep moving, blow through, evasive maneuvers.
Ah, this guy's on crack.
Uh-oh, shots fired. Heavy contact, watch out, vertigo red. Watch out, he on you, take cover. He on you. Shooter, he got shooters on him.
Oh, shit.
He right there. Watch out, who is that? Top, watch out, top. You got multiple shooters. He a real unit. Got real unit. There you go top side. You're clear to strike, Scorpion strike loose. There it is, shooters left side. He got eyes on you. No, he bleeding out. There ain't no pleading, nigga. Blood in, blood out. Matter of fact, go pick him up and make him ours. Pick him up and make him yours. Change the fight. Yeah. Change the dynamics of the fight. You fool. Now you motherfucker, you could have a 2v1 instead of a motherfucking 1v2. You fool. Yeah, I told you. Whoa, good shot, good shot. Stay frosty. See, he got his boy back. They gonna come.
Second shot. He's here, he's here, he's here.
There you go, there you go. He even got in the truck. Watch your 6. I got footsteps on you. They circling and they triangulating on your position. Oh, there he is, there he is. Keep pushing, keep pushing. He trying to get to that extraction. There he is, there he is. There he is. Stay on him, stay on him. Scorpion Link, engage. You're clear. You're clear to fire, engage. Hit. Hit. Grenade. Now you on top side. Now you gotta clear that bitch. Reload and engage. There he is. Multiple bogey. Reload. Fire wheel. Oh yeah, he know where. Yeah, he gonna try. He gonna try to make a run. Yeah, there he is. Throw a knife. Should've threw a knife.
Nice try, buddy. Thank you, but we had
No. See, you was out there doing too much. Rolling the thing. Freaking rolling, Jake shooting.